All right. Hopefully we'll be live here soon. Great. We are live. All right, let me go ahead and share this around a little bit and then we will come back. All right. So let's make this website. Yeah, I'm gonna have to silence that. Getting there. That is there. And now for, yeah. The question is, can I get it on Instagram? Probably not, because it's a video. That's not looking right. Hold on. Much better. All right, cool. Now that that's done, let's talk about some KPIs. Just minimize that. All right. So yesterday I posted some of my top 5 KPIs. There's a bunch of KPIs you can look at for a business that kind of tell you what's going on, but most of mine deal with percentage margin. So the first one we'll talk about a little bit is your gross margin percentage. And so that just tells you essentially whether or not your product costs are too high, or if they're increasing too much. So if your revenue is flat and your product cost goes up, your gross margin should go down. So it's kind of an indicator of where to look at to see where there's problems if you see your margins going down. So say your net income margin is been flat at like 12% pretty much as your revenue's gone up and down a little bit, and then it starts to drop. One of the things you can do is you can look at gross margin. Has gross margin dropped, or is it your overhead expenses dropped? So that's why I like both of those, net income percentage margin and then your gross margin. Both of those percentages kind of tell you where to look at when you start seeing margin changes in the wrong direction. And if they're going in the right direction, they also can tell you where to look to make sure that, well, if there's an issue, if something wasn't recorded correctly, maybe you need to do a look at inventory before you jump up and down about your margins increasing. So it's just a good indicator if things are going in the right direction or the wrong direction, and it gives you, kind of points out at least where your expenses, the grouping of expenses, which ones to look at to decide which ones are going in the right direction or the wrong direction. And then to go with that is your product margin. So product margin is a somewhat difficult thing to do for especially small businesses, because it takes a little bit of admin time, because you need to be tracking your costs and your revenue by product and not just lumping it all in together as one thing, which is a lot easier to do, but it doesn't give you the detail you want. So a product by product margin, realistic one, not one that you've like put down on paper based on what things are purchased for and what you're selling them for, but actually what happens in real life. And with the time of employees, if you are manufacturing a product, what those look like. So what that does is it gives you an idea of what your percentages are across your product stack, and maybe you don't need to change anything, but they're something to look at to see which products are more valuable to you to push, which ones aren't, and if the ones that aren't, either maybe you should not sell them as much, or there's maybe a good reason to sell them because they help you sell other products, or maybe there's a way for you to adjust the margin on those. Find a new distributor for the costs. So find someone else to purchase your materials from that maybe you can get them a bit better price. Maybe you've grown a little bit so you can get better deals there. So it gives you an idea of what to look at when you're trying to figure out if you can maybe just tweak some things in your business and get better margins. So tracking your project margins by product is really important for any business that's out there. And then finally, you want to look at two of my favorite things to look at from a cash flow perspective are your accounts receivable in days and your accounts payable in days. So what this does is it's just a mathematical calculation of prior year and current month receivables to tell you how much time it takes to turn them over. And so if you have accounts receivable in days of about 30 days, but your AP, accounts payable in days, is about 10 days, that means you have a 45 or 40 day period between when you purchase a product or good or service, whatever it is for your business. So you're buying raw materials till when you get paid. So you have a 40-day period from when you have to spend money to when you get paid. Well, actually, no, it's the opposite way. Sorry. The 10 would be subtracted away from, so you'd be 20. So if you can lengthen your accounts payable days to 30 to match your receivable days, then you should be get paid when you have to pay your vendors. But it gives you an indication of how far off you can be on either side. So if receivable days are really, really long, but accounts payable days are really short, so you have to pay when you receive goods, then you're not in a good position because you're going to always have your receivables out here to be collected, and you're going to always be paying up front. And maybe that's just the industry you're in. Maybe that's just how it works. You have to pay up front. But it gives you an idea of what kind of issues you need to solve so that your business can stay solvent through the fluctuations of cash flow. And one of those is getting a line of credit. So that's the quick top 5 key performance indicators I think all business owners should be looking at to give them an idea of where they're going. And if you noticed, none of my top 5 is revenue, because revenue is a very bad indicator of if your business is going in the right direction. Yes, you want revenue to grow, but what's more important is that your margins are staying the same or growing as your revenue grows. So if your most important indicator that your business is doing well is revenue, well, then you're probably not looking at the right things. So I'll leave it there, but thanks for tuning in if you did, and I'll post this video for later for those who didn't. So thanks for your time.